Welcome to your weekly update on all things tax. The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Rob Goodley and John Bull.
Welcome to the Tax Factor. I'm Rob Goodley, and it's very nice to be back in the chair again. We're firmly into the party conference season now, and I'm sure our listeners have seen many reporters in fancy mobile studios in Blackpool this week for the Labour Party conference. Things are certainly more low-key here. I'm sat in my regular windowless cubbyhole in our offices in Covent Garden. However, a bright spark, I'm here with a special guest. Joining me for the first time on the Tax Factor, and we hope the first of many visits, is John Bull, who's the head of our private client team at Blick Rothenberg. John, welcome to the Tax Factor. We may not be in Blackpool, but we have here both got a stick of rock.
Thanks, Rob. It's great to be here. Thanks for that.
Let's leave those sticks of rock to the end. We don't want anyone to break a tooth. Now, John, we're very blessed to have you on the podcast today, as you are, of course, what the rest of us tax advisors respectfully call a dual handler, as you advise your clients in respect of both UK and US tax matters. Now, there's been some rumours circulating over the last week or so about the UK potentially introducing an exit tax. I know the US has one of those already, so I'm really keen to get your thoughts on that. However, before we dive into how the UK tax system may evolve over time, let's spend a bit of time in the here and now. John, the Low Income Tax Reform Group have been making some noises this week about the new reporting rules for digital platforms. Could you just remind our listeners what those are and what the Low Income Tax Reform Group are concerned about?
That's right, Rob. From the 1st of January this year, digital platforms that connect buyers and sellers, like Airbnb and Vinted, for example, are obliged to collect data in relation to transactions entered into by their users. That data is to be collected on a calendar year basis and then reported to HMRC by 31 January of the following year. So, HMRC are due to receive their first reports in just over 4 months' time. The intention here is for HMRC to identify individuals who are carrying out a trading activity and aren't paying tax on the profits that they're making. So we aren't talking about people who are selling the odd personal item here and there, pair of trousers, etc., but rather people who are carrying out a proper trading activity, what's referred to in the press as a side hustle. Under the reporting rules as they stand, individuals can make up to £1,000 of profit per year from a side hustle without this being reported by the online platform, effectively without having to pay any income tax. However, where that threshold is exceeded, profits will need to be declared and tax paid to HMRC. The Low Income Tax Reform Group's concern is that, in their view, HMRC are not doing enough to publicise the need for people to pay tax on their side hustle profits, giving those people the chance to be compliant. The concern is that people will sleepwalk into non-compliance and HMRC will then use a sledgehammer with inquiries and penalties.
Thanks, John. Yeah, I think the criticisms made by the Low Income Tax Reform Group are quite fair. I think even within the profession, there hasn't been much noise around this. There is also, of course, the very real problem, which has been highlighted on this podcast many, many times, that getting hold of someone at HMRC and getting a sensible answer is far from simple these days. So it's an uphill struggle even for people who desperately want to be compliant. With a view to providing a little bit of balance here, as far as HMRC is concerned, I think we should, as a side note, offer the revenue some praise, just hot off the press this, for making 11 arrests this week in relation to suspected R&D tax relief fraud. I won't go into any detail on that now, as our resident R&D tax partner, Ellie, is in the chair next week, and I definitely don't want to steal her thunder. But a pat on the back is due to HMRC for taking action to protect the taxpayer there. Moving on to the broader picture in the UK right now, we did, of course, have the Chancellor's keynote speech at the Labour Party conference this week. Many of us were naturally listening very closely to see if we might get a better idea of what might be coming in the upcoming budget at the end of October. But sadly, Rachel Reeves kept her cards quite close to her chest. There were three standout themes for me, though, which I think give us a clue as to the likely direction of travel. Firstly, lots of smiling and lots of positive noises about investment and growth. I think the government has got the message that Keir Starmer's doom and gloom speech from a few weeks ago didn't exactly help economic confidence, and that the electorate need to be shown that there is a path to economic growth. Secondly, and linked to that first point, there were strong hints from Rachel Reeves that she will announce a change to the government's fiscal rules in the budget, allowing the government to invest more money into the economy. And third, the Chancellor was very clear that there will not be a return to austerity, and that in fact she expects government spending to increase in real terms over over the course of this parliament. And I think taking those three things together, it seems to me like the government recognises that we need more public investment to really kickstart the economy. But they want to do that whilst making the gap between day-to-day spending and tax revenues look as small as possible. But really, there's only so much that can be done when spending is expected to increase in real terms. So I think for me, that means that the pressure to raise taxes in this budget has actually increased slightly, I think, having heard that speech. The government continues to roll out rises to the big four taxes: income tax, national insurance, VAT and corporation tax, which raise the vast majority of the total that the government get each year. There are obviously kind of hidden ways they could raise tax revenues through those taxes, in allowances and reliefs, etc. However, it feels to me like changes to capital gains tax and inheritance tax are now very likely. And I think it's fair to say that many of our clients are concerned about that. John, assuming the government are looking closely at those two taxes, where do you think the axe might fall?
Thanks, Rob. Outside of well-publicised focus on non-doms and private equity executives, I think the government could look at the following: capital gains tax rate increase on the sale of investment assets, and perhaps a more modest increase on the sale of business assets. A shift to mirror income tax rates feels a step too far, but perhaps a shift to a rate to align to the rate applicable on the sale of second homes feels like something that will be within Labour's wheelhouse. This could be coupled with a return to taper relief to mitigate the effect of inflation. Moving on to IHT, inheritance tax, removal of the inheritance tax residence nil rate band feels like something that's highly likely. That was a Conservative innovation, and so right in the firing line to be removed or adjusted by a Labour government. More broadly on inheritance tax, agricultural relief could potentially be scrapped and business relief tightened, perhaps so it removes AIM-listed shares from the relief and companies that carry out substantial investment activities. Perhaps also a reduction in the nil rate band, currently £325,000, reducing this to, say, £200,000 could bring more estates into inheritance tax. Labour have previously noted that inheritance tax is too narrow, catching only 4% of estates. So this could be combined with a shift away from the flat 40% rate of inheritance tax to progressive marginal rates. Wider, more radical reform to inheritance tax feels unlikely at this early stage, but thinking more medium term, the government could move to mirror most of the OECD countries to implement a beneficiary-based tax system, perhaps reinforced by a lifetime gift tax.
Thanks, John. I think, I agree that all of those are possible. I'm not convinced the government would raise very much money from any of those changes, really, but you could certainly see how they could be included in a kind of package of measures that would allow the government to stick by its manifesto pledge of not increasing taxes on working people. Some of the reforms, maybe looking at taxes on gift, etc., are probably more of a long-term play for the government, but certainly a few things they could do in the here and now. Given we're talking about capital taxes, John, though, I want to come back to my statement about an exit tax at the start of the session. We can't ignore the noise there's been over the last 7 to 10 days about the UK potentially introducing its own exit tax on people leaving the UK. So in short, the idea here is that people leaving the UK will be deemed to have sold all of their assets at their market value, giving rise to a capital gains tax charge, an exit charge. Not a new idea, but it's hit the news again as the Resolution Foundation think tank has urged the Chancellor to introduce one of these taxes to the UK. Our very own Vanessa Kistu was asked by the FT to give her views on this, and she rightly said, in my view, that it could drive investment away from the UK, so it could be counterproductive. Personally, I can't see any prospect of an exit tax being introduced in the short term in the UK, but I think we can't rule it out longer term, especially since many other Western countries have them, like Australia, the Netherlands, and of course, John, as we're going to come on to, the US. I think your average man on the street would find it strange that a business owner could create a valuable business in the UK, leave, and then pay no UK tax on the resulting gain. Equally, if the opposite is true, someone could come here having grown a business abroad and pay a huge sum of tax here. As a US tax advisor, I wanted to get your views on how this tax works in the US. Does it raise much revenue? Does it distort behaviours? Is it a good thing for a government to do?
Well, Rob, the US does impose an exit tax, but not on individuals ceasing to live in the US, which is what's being contemplated, as you've talked about. Rather unusually, the US operates a citizenship basis of taxation, and the exit tax then applies to individuals who formally renounce US citizenship or indeed relinquish a US green card, having held it for any part of 8 years. The exit tax does operate in the way that you describe, i.e. taxing appreciation of worldwide assets, including pensions, but only bites if the individual is expatriating for tax purposes. One of the key definitions there being if the individual's net worth is more than $2 million. For many exiting the US tax net, the exit tax is typically not a concern, either because their net worth is less than that $2 million threshold, or because any deemed gain on exit is less than the relatively favourable exclusion amount, which for 2024 stands at $866,000. That said, the tax does influence behaviour. Going back a few years now, Eduardo Saverin, one of the co-founders of Facebook, famously renounced US citizenship in 2011 ahead of a significant Facebook IPO to mitigate his exposure to US tax. It is possible to plan to mitigate exposure to the US exit tax, and we might expect similar planning opportunities to be available should the UK ever introduce such a regime.
Thanks, John. I do think, having some countries impose exit taxes with others not doing so can really create some strange scenarios. A few years ago, I had a client moving to the UK from Australia, sitting on some private company shares that were standing at a really big gain, and he suffered quite a big exit charge when leaving Australia, but that was obviously not recognised at all for UK tax purposes, meaning that he faced the prospect of a big tax charge in the UK when he actually came to sell the shares down the line. So understandably forces people to undertake kind of tax planning just to get themselves back into the position where I think everyone would think they really should be. So it's a difficult one. I think it can create probably more problems than it can solve. So that's nearly all we have time for this week. We did just want to mention that we were sad to hear that John Brown, VAT expert, and more importantly, Jaffa cake champion, has recently died.
You will know that if you're a regular listener, that VAT, its execution and challenges are often the cause of frustration and indeed merriment here at the Tax Factor. Jaffa cakes were introduced by McVitie's in 1927. With the start of VAT in 1973, customs and excise took the cake label at face value, meaning that they were zero rated for VAT purposes. However, in January 1991, a review led to a change of heart. Jaffa cakes were denounced as chocolate-covered biscuits, with orders that VAT should be added to their price. The dispute went to a tax tribunal, with John Brown, a VAT expert, representing the company. The case, understandably, won huge public interest, as John Brown persuaded McVitie's to produce an improbably cake-sized Jaffa cake that he called a Max Jaffa. He also demonstrated that Jaffa cakes, like other cakes, go stale and hard if left in the open air, while biscuits go soft. He said at the time, "The law has not changed since VAT was introduced, and neither has our product. The only thing that has changed is that customs and excise have changed their minds," adding that he suspected their motive was the millions of pounds they stood to gain by the imposition of VAT. They wish to extend taxation by reinterpretation, he concluded. John was a member of the Worshipful Company of Tax Advisors, for which he famously handed out Jaffa cakes to children lining the route of the Lord Mayor's show.
I think that case will live on in VAT folklore for many, many years yet, and it's still a great example of the peculiarities of our VAT system, or our creaking VAT system, as Heather would say. What a great approach, turning up at the tribunal with a giant Jaffa cake. I think we need a little bit more of that in our tax tribunals these days.
The Tax Factor.
We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever is most convenient for you. We record and release them in less than 24 hours, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review.
Thanks for having me on the podcast, Rob. I'm in the mood for a Jaffa cake now, and not a stick of rock. Next week, we have Rahana and Elle in the hot seat as we head towards the budget at the end of the month.
But from us, it's goodbye and have a good weekend.
Goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.